For decades, global markets operated on a predictable foundation of stable alliances and open trade. That era is over. We have entered a period where geopolitics dictates capital flow, and international partnerships are breaking apart into isolated regional networks. A Trump presidency guarantees that shifting alliances and international unpredictability become the baseline. Chaos is the stated operational strategy. Traditional allies are pressed, and adversarial nations are forced into new partnerships to bypass American influence. This isolationism carries a specific structural threat to the US dollar. Currently, the dollar is the world's reserve currency, the standard money held by central banks globally to conduct international trade. But as protectionism rises, foreign nations are actively building systems to trade among themselves without recycling dollars, threatening the core value of American currency. The immediate result is a global market anchored in FUD, fear, uncertainty, and doubt. Between erratic tariffs, shifting supply chains, and active conflicts, elevated market volatility is now the permanent reality. Relying on the traditional investment playbook of quiet, predictable growth is a guaranteed way to get left behind. Beyond the geopolitical fractures, the physical participants in the market have undergone a total transformation. The vast majority of global wealth is held by a baby boomer generation that wants safety, income, and low volatility. However, they are being replaced by a flood of younger, hyperactive traders who treat the market like a casino, demanding a daily dopamine hit. To feed that daily habit, Wall Street popularized a specific mechanical tool, zero DTE options. These are 0 days to expiration contracts, aggressive financial bets that expire on the exact same day they are purchased. This stark area chart shows exactly how dominant this fast-twitch trading has become. Traditional volume is rapidly eclipsed by the zero DTE wave, now 50% of daily trading. Because half the market makes heavy, expiring bets, it triggers wild market spasms, driven by clearinghouse ledgers. This creates a dangerous trap. Everyday investors see the market violently drop by 2% in an hour, assume a systemic economic collapse is underway, and panic sell their high-quality assets. They mistake mechanical noise for reality. To survive this mechanical volatility, we have to reset our expectations using actual historical math. Over the past 17 years, institutional and retail investors alike have developed a deeply broken muscle memory. If you bought into the market at the absolute worst possible time during the 2009 recession and simply walked away, your portfolio grew by a blistering 16% annualized return. Investors have been spoiled by nearly 2 decades of atypical, unnatural gains. This split-screen chart illustrates the gap between recent memory and mathematical reality. The steep 16% line is what people expect, but the bottom line is the true historical linear trend, closer to 10%. And the required price of admission to get that 10% is enduring frequent drawdowns of 10 to 20% along the way. This recurring pain signals a mathematical reversion to the mean, providing a necessary correction to the unsustainable growth of the previous decade. Assets occasionally drift too high, and the market checkback to the historical trend is a standard part of the process. The financial media relies on these reversions to sell panic, warning that a catastrophic market crash is imminent. But if you look at the raw data, the damage they are warning you about has already happened right under your nose. This cross-section visual shows the S&P 500, an index tracking 500 of the largest U.S. companies. The surface line looks relatively stable. But underneath, the average individual stock has already suffered a deep 14% pullback. If we escalate this and look at the tech-heavy NASDAQ index, the internal damage is even worse. The average stock inside the NASDAQ has endured a severe 28% drop. In fact, a mere 19% of the stocks in the entire market are keeping the top-line indexes afloat. Because the structural damage is already priced into the individual stocks, running for the exits now is a mistake. The crisis phase is largely over for these businesses. We are currently looking at a wide, broad market discount. With the market significantly discounted, the question becomes how to allocate capital in an economy that operates entirely differently than it did 5 years ago. This environment has accelerated the efficiency paradox. Corporations are rapidly deploying artificial intelligence to cut costs, flatten their organizational charts, and achieve high-tier sustainable profit margins. However, those corporate efficiencies require substantial layoffs. A leaner, highly profitable corporate America directly produces a structurally weaker consumer. When broad employment drops, discretionary income dries up. Because the consumer is squeezed, stock picking becomes highly restrictive. You must limit your exposure to must-have value retailers, companies that actually see increased foot traffic when household budgets tighten. The other safe haven lies in digitally native platforms and subscription services. Consumers will cut almost any physical luxury from their budget before they cancel their smartphone connectivity, streaming services, or digital ecosystems. That reliance gives those specific companies ultimate pricing power. Above the consumer level, you look for the dual compounders. These are enterprise software giants that expand their own profit margins by cutting their internal headcount with AI, while simultaneously selling those exact same AI efficiency tools to thousands of other businesses. The efficiency paradox forces a harsh reality. You can no longer afford to own middle-of-the-road brands. You must exclusively own the structural monopolies that either enable the AI revolution or can survive a period of consumer poverty. Outside the consumer space, several major megatrends are completely disconnected from the broader economy. A scarier geopolitical map and the rise of cheap disposable drone swarms demand a significant, heavily funded rewiring of global military infrastructure. Defense contractors have the best revenue visibility they've had in decades. Meanwhile, the AI revolution faces a brutal physical bottleneck, the electrical grid. You cannot build data centers without power. The aging global grid requires trillions in mandatory upgrades just to keep the servers running, triggering a profound, decade-long supercycle for energy and infrastructure companies. Finally, demographic math points east. An estimated 1 billion people in Asia will join the middle class over the next decade. Combine that exploding consumption with the region's total dominance in advanced tech manufacturing, and Asia becomes a critical allocation that most Western portfolios completely ignore. When you see extreme market volatility, human instinct screams at you to sell. When put buying, financial bets that the market will crash, reaches a fever pitch, the natural reaction is to join the panic. But high uncertainty is the only mechanism that forces world-running franchises to go on sale. If you can ignore the dopamine-driven noise of the options market, you can buy the fear. By purchasing high-quality assets during periods of geopolitical chaos, you compress your timeline to recovery and build true generational wealth.